Hey everyone, welcome to another edition of the Buddy Study Group. And we are here with Tim Go today because Securian has just, and I mean just, released their SecureCare 4 product, I believe, yesterday. So there's a lot to like about this plan, whether you haven't looked at or written much Securian, or if you are a grizzled veteran of the SecureCare product. There's going to be things you see that you like in this presentation. Tim, I don't think I need to say much more. I will let you take it away. You're kind of master of ceremonies today. Thank you for being here.
Yeah, no, thank you, Jason. Thank you, Mark. It's been a minute since I've been on one of these study groups, and so it's good to see everybody. And it's been a minute since SecureCare, since we've launched something new. So, as Jason said, we launched SecureCare 4 yesterday. Super thrilled about it. There's been no price changes, so we're keeping our super competitive our competitiveness from SecureCare 3, and we're just adding some enhanced features to SecureCare 4, which I'll kind of dive into. So I'll keep this product based, but I'll also dive into some sales ideas, which won't be groundbreaking in the industry, but I'll kind of touch on how SecureCare can fit within that, particular to business owners, so S Corp, C Corps, etc. But diving into SecureCare for those of you who aren't familiar with Securian, I always just have to do this like most carrier reps do. But in the space of long-term care, I think it's really important just to reiterate our financial ratings, kind of our balance or our portfolio and how we want to balance that portfolio since we've been around for over 100 plus years, Comdex in 95. We've always been a life carrier. We've dabbled in the long-term care space. We're a significant group life carrier. We have a big voluntary benefits division. And we have a significant life book. And when we launched Secure Care back in 2017, we were very comfortable with this risk that we're getting. We're very comfortable guaranteeing, basically every feature on a Secure Care policy. And in conversations with our actuaries, they've indicated to me that, there's really no amount of business that we wouldn't be okay with for Secure Care. So we're in a really good spot. We're really comfortable with our financials, and I hope that, allows you to be comfortable with our financials as well. Mutual-based company in Minnesota, and we're just very proud of how we've built products and how we manage our policies. So I'll touch on SecureCare 3, but just being excited about the launch. What's new with SecureCare 4 is we added really, I would say three, but four main benefits adjustments. So we're adding a retroactive long-term care benefit. So, we have that 90 calendar day elimination period, kind of taking a page out of Nationwide's book, but really in month four, the insured will receive 4 months of benefit all at once, right? Now, we are a differentiator, and I'll touch on this again later in the presentation, but we are a differentiator in that we will pay benefits during the elimination period. So we offer up to $5,000 for caregiver training, home modification, and $1,000 for caregiver training. So $6,000, no matter the size of the policy, will offer $6,000 during the elimination period. Now, I say that, and we're also a cash indemnity policy, right? And our definition of cash indemnity, when you look at the policy and you look at the requirements, because it feels like every linked benefit carrier has some sort of definition of cash indemnity or some sort of cash indemnity option, ours is going to be the most flexible. We require a plan of care, but we don't enforce that plan of care. What that really means is that we do not require any type of verbiage within that plan of care. So even in the policy, we say, hey, $5,000 for home modification, $1,000 for caregiver training. Our actuaries and our claims department says, we're not enforcing whether or not they're using that money for those two services or those two reasons. They just need to ask to collect that $6,000 during the elimination period. And then, expanding to the greater benefit pool. We're not requiring that informal care or home services are specifically spelled out in that plan of care. Once they satisfy the requirement to go on claim, we're paying those cash indemnity benefits to their bank account, and they're free to use that however they would like. So there's a very powerful, very flexible, very simple long-term care benefit with SecureCare. So SecureCare 3 and SecureCare 2 back in the day, it's always been a short pay contract. We've always positioned ourselves as being, higher end clientele, larger premium checks, single 5, 7, 10, 15 pay options with SecureCare 3. And we've always seen that around 35 to 40% of our policies are issued as single pay, with, I want to say, like 25% being issued as 10 pays. In discussing with the actuaries and building out SecureCare 4, I think it made a lot of sense for us to add a 20 pay, really open up SecureCare to a different market, really make it way more approachable, way more affordable. Our issue ages are from ages 40 to 75. With all of our pay options, other than single pay, they have to be finished paying premiums by the time they're 80. So the max issue age for a 20 pay would be 60. Max issue age for a 10 pay would be 70. But what our hope is that we're going to start seeing a lot more people, gravitate towards secure care as a solution that may not be in that super affluent market, right? That clientele, start being way more approachable. We're adding 100% international benefits. I'm super happy about this, having, relatives abroad. This might be an option for me down the road, my relatives. But I think this is just, again, leaning towards the simplicity and the flexibility of Secure Care. With Secure Care 3, it was 50% of the monthly benefit was the max, right? So we would throttle back, and the total pool of benefits would be eligible for payment. So a 6-year benefit would essentially turn into a 12-year benefit. With SecureCare 4, it's no different if you were to go on claim within the US or abroad. Um, Insured would just need to get medical records submitted to us in English, right? We're not going to translate it for them. They have to provide that to us in English, but they don't have to hunt down a US licensed physician wherever they are. Once they provide the medical records to us, our claims team is going to evaluate that claim. And once approved, we will pay benefits in USD to a US bank account. And then that fourth option, enhanced death benefit. With SecureCare 3, there were a select few cells. Typically, we saw this with women 68 and above, with heavier inflation options where the death benefit was actually lower than principal. Um, we just wanted to get rid of that. So there will be no circumstances, no policy design, no cells where the death benefit will be lower than the cost basis. The death benefit will always be at least at cost basis. Oftentimes it will be a little bit more. As we're all familiar with linked benefit products and hybrid LTC, the main purpose of a secure care policy is going to be that long-term care benefit. That's going to be where the majority of the leverage they're buying will come from. And that death benefit will typically be a return of premium upon death, maybe a little bit of leverage, right? So this isn't going to be a life insurance solve. It will typically be, or mostly be, a long-term care solve. And then a product as a whole, and this is the same slide we've used with SecureCare 3, is that very high level, four main guarantees. I know I'm on a recorded line. Our marketing team doesn't like it when I use this term, but it's really a bulletproof contract. It's fully guaranteed. I think we say guaranteed 10 times plus on our illustrations. There will never be a scenario where the insured or the policy owner does not use this policy, right? I talked about that cash indemnity benefit, the flexible definition that we use within the contract where we don't enforce a plan of care, we enforce them having a plan of care. That guaranteed death benefit, guaranteed return of premium option. So we have long-term care boost, which maximizes long-term care and bases the return of premium on the internal interest rate. We have a 100% vested option and a 75% vested option. And then we have a reduced paid up benefit, which is a very understated, benefit that is, I feel like should be given a lot more credit. So no matter when, if somebody were to issue a policy or have a policy that was a multi-pay, let's say $10,000 a year for 10 years, in year five, if they stop paying premium for whatever reason, life happens, we're not just going to lapse the policy and give them nothing. We're going to give them a proportionately paid up policy based on the premium that they've already paid in, right? So in year five, if they stop paying premiums after that fifth premium payment, we would give them a $50,000 policy basically. And it will continue to inflate at whatever inflation option that they've chosen. Typically, it'll be 3% compound, but inflation wise is 3% compound, 3% simple, 5% compound, 5% simple. This will become even more powerful with our 20 pay as well. One thing I didn't include or is not on this slide is that we have waiver of premium like many of our other competitors, but a differentiator is that we include where we offer the option to get waiver of premium on every single policy design. Some carriers will only offer it for life pays. Other carriers won't have it. For us, it doesn't matter if they're doing a 5 pay or a 20 pay. They can elect to get that. Now, before we offered the 20 pay option, the cost for that rider was very, very insignificant. Typically, it'd be less than 1% of premium, right? Of total premium would be the cost. Running the numbers, now if you have a 60-year-old that's doing a 20 pay and they want waiver of premium on there, there's a good chance that they go on claim while they're still paying premium. The cost for that waiver of premium rider might be close to 7 to 10% of the overall premium. I still think it's worth it. It's at least taking a shot at looking what that cost difference would be with or without that. But again, waiver of premium available for every premium design. So really proud and happy with our marketing or with our product team and our actuaries for getting expanded initial approval for SecureCare 4, right? So all the states in green, SecureCare 4 is now the new default product. California is still going to be the SecureCare UL product, which was SecureCare 2. Um, Still a very powerful product. It defaults to 100% return of premium, so they don't have the long-term care boost for the California product. So competitively, I know the main ones are going to be Lincoln and Nationwide in California. We're still going to be within 2 to 5% of Lincoln or Nationwide in California, but that's our 100% return of premium going up against their long-term care boost solutions. The SecureCare UL product also has far more death benefit than SecureCare 3 or SecureCare 4. It took us far too long to get SecureCare UL approved in California. It launched last year. It's worth taking a look at it just to see what the leverage is. For the longest time, people didn't look at it. When we first launched the product, the pricing wasn't competitive, and we repriced it almost immediately, and it's still a compelling option. Um, We'll update the group as SecureCare 4 is approved in states like New Jersey, Delaware, Connecticut, South Carolina, Indiana, North Dakota, South Dakota, Montana. I'm hoping, and the feel I'm getting from our actuaries is that we're relatively close with New Jersey and Connecticut. Um, but again, you probably all know how that works with carriers and state regulators. It can take some time with the objections. But we will make announcements as those states are made available. We don't have a product in New York, unfortunately. I don't believe we have plans to offer a solution in New York at this time. So I've touched on this already, but again, I'm going to breeze through this. Jason, I hope you don't mind going short to keep this, brief and hopefully leave some time for questions and discussion. But very excited for this retroactive long-term care benefit. It really it doesn't solve the elimination period. The elimination period is never a fun conversation to have, but considering that this is pure cash indemnity, and it will cover really, what we're going to pay benefits, whether they have qualified expenses incurred or not. That elimination period could result in a client collecting more benefit earlier on than perhaps a reimbursement contract. And now with this retroactive benefit, they're going to get a really large, significant benefit payment in that month four. And again, please don't forget that $6,000 that the client has available to them during the elimination period. Again, it's bookmarked for home modification and caregiver training. But since we don't enforce plan of care, since there's no part in the process where we look at receipts, um, they just have to request that $6,000 and they can use that. Common question I get when I say that is where does the $6,000 come from? Where is it taken out of? The $6,000 is taken out of the very last month of the very last year of their claim duration. So if they have a 6-year benefit duration, it will be in the 12th month of the 6th year is where you'll see that $6,000 taken out of. Average claim duration, as you all know, is around 2.5, 3 years. We can debate on the validity and, how accurate that actually is when you take into consideration people who are terminally ill that also qualify to be considered long-term care eligible. Um, but the likelihood of them collecting that 12th payment is smaller, right? So to have them able to collect that right at the beginning is a very powerful feature. 20 pay option. Again, this is going to open up SecureCare to more of your clients. You know, a, a pretty significant sales idea that I found a lot of success with that a lot of marketers and agents and advisors across the board, no matter what the target clientele gravitate towards, is our tax deductibility potential for our SecureCare premiums. So we make it extremely easy to break out premiums. On every illustration, we will tell you the exact annual dollar amount that is being paid towards the face amount, the waiver of premium, which are both considered life insurance costs. And then you have the acceleration, the inflation, and the extension riders, which provide the bulk of the long-term care premiums. Those are qualified long-term care expenses. So traditionally with SecureCare 3, this is a really powerful story with business owners who are 61 plus, because a 61-year-old business owner, um, oh, sorry, 61-year-old business owner, um, their IRS age-based limit is, I think, $4,800 around there. And if you did a $10,000 a year 10 pay, the long-term care premiums, if you're doing like a 3% compound 6-year duration, almost always came out to be 45%. 45% of the $10,000, like $4,500, would typically be qualified long-term care premiums. So if you had an S Corp, an LLC, a small business owner, where they had the business pay for the premiums, and that business owner as an individual owned that policy, they are able to make an above the line deduction of the lesser of their long-term care premiums or their age-based limit. So just by having them set up the policy where the company pays it, they own it as an individual, they can make or they can take 45% off deduction just right off the bat. So I say this on the 20 pay slide because this will open up things for 41-year-old business owners. I believe the age-based limit for a 41 to 50-year-old is around $1,800. So if somebody were doing a $5,000 a year 20 pay, and I looked at the illustrations, the long-term care premium proportion, right, long-term care to life insurance, will still typically be around that 45 to 50% mark. So $5,000 a year, long-term care premiums are 2,500 and their age-based limit is 1,800, they can make an above the line deduction of $1,800. So outside of just individuals, this is also powerful. And that same structure, that same deductibility can be applied to HSA funds, right? So if somebody has a robust HSA policy, they can get reimbursed by their HSA provider for the lesser of their long-term care premium or their age-based limit. So this should open up SecureCare to a lot more people. Excuse me. The international benefits, it speaks for itself. There's no math that you have to do if they were to retire abroad and go on claim abroad. It'll just be paid the same whether it's domestic or international. An enhanced death benefit, you just will never have to worry about having a conversation about, hey, why is my death benefit lower than my cost basis, right? It will always be at cost basis. Product features, again, third time I'm going over a lot of these, but this is just really the technicality of everything. Um, I'm not going to read through this, but really, the two things that I want to highlight on this slide will be 4 to 8 years long-term care benefit duration. You'll see that, like most other carriers in the space, the largest like leverage you're going to get will be with the 6 year duration, but we see a lot of 4 year durations as well. SecureCare being cash indemnity, our strategy, our play, which is our hope for our advisors and marketers and clients to really think of SecureCare, is how fast and how much of the long-term care benefit can I collect, right? Because if they pass away prior to using their long-term care benefits, that just goes unused. So 4 years are becoming more popular. 6 years is also obviously very popular just by the leverage. And then the premium deposit account agreement. This isn't talked about as much because it's not really a point of sale topic, but we provide the ability for our clients, if they got a windfall, to pay up a multi-pay policy early, right? So if they're 5 years into a 10 pay, and they just want to pay off that policy, we have a premium deposit account which will have an interest rate that will change. So there's a website that they would go to. Let's say the premium deposit account is 3%, right? There will be a calculator on there to calculate, hey, how much money do I need to put into this in order to pay up the policy early? So again, this will come into play a lot more with that 20 pay option. Jason, I'm not looking at the questions or anything that you think I should address at this point.
I think Diane asked a really good question.
Yeah.
She kind of verified that rates were the same as SecureCare 3 after running quotes, but basically the question is, how are you able to add this flexibility without, you know, increasing premiums? Is there anything that is actually offsetting that? Is there anything in underwriting, any other terms that are kind of counterbalancing that, or are you guys just that good?
So yeah, I wish I had more of an actuarial brain and, I wish I had a better look at behind the scenes. That was our biggest worry, candidly speaking, when we started looking in 2024 of, hey, what do we want in a product update? Obviously, every wholesaler on the team was like, we want an annuity and we want a joint product. Those were our two asks. And the actuarial team was like, we're not quite there yet. That's probably a 2027, 2028, launch. In the meantime, they still wanted to do something. So before we even gave them anything, we're like, whatever we do, we don't want to do it at the expense of service and pricing. So I don't know what levers they had to pull. I do know that Securian is looking to invest more in this product line specifically. At the beginning of the call, I mentioned kind of our portfolio of our, in-force products. We're very comfortable with our life portfolio, but having a secure care segment grow is a very good offset to our IUL and our VUL and our whole life business. So it's more of an actuarial thing. I assure you that service and underwriting isn't being impacted negatively by this. In fact, we're looking at enhancing a lot of this, especially on underwriting. We're going to hopefully add some relationship underwriters within the next 1 to 2 years, and we're doing a big AI underwriting revamp on the life insurance side, which we'll see, effects on the long-term care side. So there's no gotcha here. There's,
Yeah,
you
and
know,
as somebody who's hung out with several actuaries for way too long now, I would say reaching a new market and increasing sales across the board is a pretty decent way to offset. But um, you know, that's me, that's not Mark Glickman saying that, but actuary hat on, I think just increasing market share and increasing revenues could certainly allow for some of these changes and not affecting pricing.
Yeah, I think, and this is me speaking candidly as just my own personal experience, as a carrier, where you look at some of our other competitors, One America, Lincoln Nationwide, they've made significant investments in their products and their servicing. And, the last product and service enhancement that we really did was in 2023, not including the major price update that we've had, plus some minor service and, product enhancements. So, Securian is committed to being a major player in the space. The product is built that way. Our service team is scaled up for that. So, really it was us making a business decision and an actuarial decision is, hey, what levers can we pull to make this even more appealing to reach a greater audience and to really, again, still play in our sandbox, which traditionally has been that higher end, more affluent market, right? With those single pays. We still anticipate seeing the majority of our contracts being issued as single pays because that's where you're going to get the most leverage, but we have the appetite to spread that out more.
Awesome.
Any
Anybody
other?
else? Yeah, have any questions for Tim while we got him here? And I would just say, reviewing a lot of these changes, keyword I would give is client centric, right? Consumer centric, benefit changes from international benefit to retroactive elimination period to more flexible pay modes. So, I love seeing companies change around their products to add more things that clients really like and appreciate, whether they know about them all initially or not.
Yeah, absolutely. I do want to touch a little bit on, competitive spots. I'm not going to spend too much time on the slide because I've hit it like two or three times. Same thing with here, just kind of, showing, hey, this is what a claim process would look like from a benefit standpoint. Again, hitting on the $6,000 during the elimination period, why not? And then still getting the 4 months of benefit paid out in that fourth month after the elimination period is done. And then again, it's just reiterating that our definition for cash indemnity is we don't enforce that plan of care. We just require that a plan of care is in force. So 20 pays, it is so hard to compare because the only other carrier, and I'm talking about hybrid, linked benefit, asset base, I don't, we haven't really, as an industry, kind of dialed in on one specific term, which has been noted publicly a lot. But, I always refer to it as linked benefit. 20 pay wise, the only one amongst Nationwide, Lincoln, One America, and us is One America. And the competitive edge we have in this, across all ages is pretty significant. The next closest will be Nationwide, which is a pay to 65. So it's not quite as apples to apples. So it's hard to kind of, illustrate that for you, but I just wanted to throw some numbers up here. The thing that stood out to me as I've been running 20 pay quotes just to get as, an RVP, you know, a grasp of where we stand is the death benefit is pretty significant when you look at a 20 pay across all ages. It's not going to be a life insurance solve, but again, $5,000 a year for 20 pay, their death benefit might be, 120, 130, $140,000. It's pretty compelling if they were to pass away, 5 years into that. And also, the long-term care leverage that you're getting with this 20 pay option is pretty significant as well, especially if you really put this in front of a 40-year-old whose parents might be going through this or whose grandparents may have gone through long-term care. I'm sure everybody on the call here has had experiences with, the long-term care conversation happening with younger and younger clients, where traditionally it was 55, 60 plus, and now it's really going sub 55 and even sub 50. People who are interested in talking about long-term care and interested in getting a solution. This is 45-year-old male, $5,000 a year, 20 pay. Again, significant leverage that they're getting. Um, just a few more options. And we're still kind of working through, our competitive marketing pieces. So once I get that, Jason, I'll send them out. But I do recommend that, if anybody has a spare moment and they're curious and they want to look at the leverage that they could get with a 20 pay, we're on WinFlex, we're on Insight, and we have our website, our advisor site as well, where you can run illustrations. Underwriting. Nothing has changed with underwriting, but it's always good to talk about it, right? So, our underwriting process remains simplified, no labs. It's simply if they're doing an e-app, which I highly recommend everybody do, they can do a digital part two. So, no phone interview for medical questionnaire, they can do that digitally. It's called client collaboration. So, when you do the e-application, you click client collaboration. Client receives an email. They fill out their medical questionnaire. If they're 60 plus, they'll do a cognitive assessment still over the phone with Securian. But it drastically shortens that phone interview experience, which drastically improves not only their quality of life, but all of our quality of life as well. It's just a much, much better experience the more digital they can do. Now, if they're more comfortable doing a paper app, and if they did want to do that over the phone, they can do that as well. I mentioned 60 plus for cognitive assessment. That's just going to be a word recall, right? So, Mr. and Mrs. Klein, I'm going to read to you 10 questions or 10 words. I want you to read them back to me. Please don't use pen or paper. Um, Pretty simple. We will order medical records for cause only, right? So if somebody is super healthy, no need for medical records, we're just going to put them right through. If they have a more complicated medical history, we will order medical records on their behalf, on your behalf, and we will evaluate that. So from when we have all the medical and underwriting requirements that we need to when a decision is rendered is 6 business days. And props to our ops team. They put that in writing on our like what's next application guide is 6 business days. So if you had a client that was willing to do an e-application, they submit that, especially if they're younger than 60, right? Submit the e-app, they fill out the medical questionnaire, they don't have to do a cognitive assessment, so there's no additional step. Let's say there's no medical records that's needed. We'll get a decision to you in a little over a week and oftentimes under a week, right? Especially if they're clean. Um, if they have an APS, medical records, obviously that extends that time frame because it's 6 days from when we have all the information. I'm saying all of this because it's all on the next screen, but I want to preempt, the pre-screen process is so important. Our approval percentage is 74%, and we've held steady at 74% for 2 years about. Um, Much of that is due to our field being used to working in our informal or pre-screen process for SecureCare specifically. So use that email address. They'll get back to you within a day, most often than not. And the people who are at the end of that 888 number are the actual underwriters that are evaluating cases. So if you have a complicated client, the one that always comes up is, hey, somebody had a knee replacement or they had some sort of operation, and you're trying to find out what that postponement period will look like. Well, that postponement period might be dependent on what their treatment or their rehab looks like. And sometimes people are given options on what they can do for the rehab, or they start something and they stop it, or, so it's always good if you have a complicated case to call, because at this point in the process, it's not client specific. There's no client name, there's no, application, there's no case associated with this pre-screen. So you can ask them hypotheticals if you really wanted to. If you had a curiosity, you could call them and ask them what that would be. So whether you call them or whether you email the team, if they give the green light, they say, hey, based off of everything you told us, they're good to apply, or they're good to apply if A, B, and C, or they're good to apply, but they may need medical records, so just be prepared for that. They will always give you a pre-screen ID, right? It's a number, and it's an ID that's specific to that pre-screen. if you include that ID on the application, whether it's on the e-app or a paper app, it will just give another point of reference for the underwriters and will continuously speed up the process, right? So please, um, it's always good to collect as much information on the front end, as we all know, being good long-term care agents. Using this process will drastically improve your experience and will drastically reduce the amount of times that you're surprised with a client's decision. This is what I just talked about before. There's a authorization release on every application. There is a box on there, so the client can sign that authorization, but there's a box that says, I do not want to share my information. Sometimes people click that without thinking, and that's fine. It's their private information. So they very much so can and should click that box if they are uncomfortable sharing, medical decisions or medical information. But if somebody were declined and you wanted to work that case with Securian or myself, we're not going to be able to share any information with you until we get an updated medical authorization with them checking the box. Yes, I'm willing to share information with you or an office manager. You can dictate or they can dictate who they share that information with. So it's very administrative, but it's really important for me to bring that up because it can reduce some frustrations on the back end. Jason, did any questions come up while I was talking through underwriting?
We did have one. Gene asked thoughts or any information you have on Securian's growth year over year, and also have you seen many applications for replacement of existing policies or from people who have been previously declined?
You guys are really making me think, trying to provide some good carrier information. We had a down year last year. Year over year for the previous, I want to say 3 years, we grew consistently. Last year was a slight decrease. A lot of that is going to be attributed to the market, right? Our Nationwide has come out with some significant enhancements and product offerings. Lincoln they've repriced. So it was a tough year. It wasn't to the point where, it put Securian or SecureCare in jeopardy. So it was just the first year in a while where we haven't grown as a product line. And in terms of replacements, I don't have that information available. It doesn't come across my desk all that often. There is an additional approval process, right? If they're replacing a long-term care specific policy, there's an additional compliance form that they have to fill out. It's like, hey, why? Can you give a little bit more insight? And then we have a committee that will, opine on that and give the thumbs up or thumbs down. In the last 3 years, I haven't come across a single case where we've declined a long-term care replacement, at least not that I'm aware of. I know that's not the most complete answer, Jane. I apologize, but it's what I have right now.
Perfect. Anybody else have
I
any?
have
Yeah, go
two. I
ahead,
have two
Diane.
questions. Hi. Hi, thank you
Hi.
for being here. I
Yeah.
love Securian. You're my favorite
Oh.
company. So,
Well, thank you so much.
but I do have two questions. One, is I have a client who's in underwriting right now, and if she's
Mhm.
approved, what is the time frame if she says I'd rather change to the SecureCare 4 once I'm issued?
She's in a state where SecureCare 4 is approved. She will get SecureCare 4.
Okay, because it's
Yeah,
the same
well,
rate and the same benefit, just more flexibility.
yep, yep.
Okay.
So, this has been the easiest and most fun product launch and transition that I've ever been a part of. Granted, I've been in the industry for 10 years. Because anybody that had an app like previously, let's say somebody was approved last week and they wanted SecureCare 4, the only thing that they would need to provide to us is a SecureCare 4 illustration and an amendment. It's a one-page amendment.
Hmm.
If there are policies or applications in flight and haven't been issued, the application will automatically switch to SecureCare 4. So at the time of issue, it will be a SecureCare 4 app. Now, if anybody has placed a case within the last 30 days, so if there's been a case that's been placed and they're still in the free look period, they can, it's a very easy process. They just have to submit now this is for all states except Arizona, and I'll talk about Arizona. So they just have to give us a SecureCare 4 illustration and an amendment. So you'll want to talk to, your BGA case manager to correspond with the SecureCare case manager. We will free look that policy and then we will reissue the policy as a SecureCare 4 policy. If you have an Arizona client that has, put a policy in force within the last 30 days and they're still in the free look period, Arizona this year just joined the compact. So their applications have changed. Therefore, we would need a new application in addition to a SecureCare 4 illustration, and that's specific to Arizona. In every case, no new underwriting has to happen. It's more so an administrative, task that you'll have to do. But in the conversations that I've had, it's been welcomed, right? You're going back to the client with good news. So
Hmm.
more often than not, they're going to be happy with
Yeah.
providing that amendment.
Yeah, I'm sure she'll be happy. All right. And then my one other question so far is you were mentioning the premium deposit account to pay off early.
hmm
So, like, let's say I have a 10 pay and they want to pay it off in year seven. Are you saying you're going to calculate what would be needed to continue the next 3 years of payments and then that's what they pay you?
Yep.
Okay.
Yep. So it'll be, it's on our advisor site. It's a premium deposit calculator. Whatever our premium deposit account interest rate is at the time, right? It can change daily. I don't think it has. I don't know what the latest percentage might be, but I think it's like around 3% typically. It'll tell you it's like, okay, like, if you have $30,000 left, you'll need X amount, right? It'll be less than $30,000 because it's
Right,
taking
right.
into account that interest rate.
Okay. And then you continue paying the next 3 years with that account.
Yep. Yep.
Okay. Perfect. Thank you.
Yeah. Any other questions?
Any other hot buttons in underwriting where Securian is easier or perhaps even more strict?
Mm, not as much on like the life insurance side. I feel like across the board, the underwriting manuals between Lincoln, Nationwide, One America less so. I think One America is a little bit more lenient, but more so Lincoln, Nationwide, and us. They'll all generally be the same. The situations that I run across where perhaps somebody has been declined, maybe at a One America or a Nationwide, and they're trying to reapply with SecureCare. Typically, those situations where we have good luck of getting them a policy will be they failed the cognitive assessment with the other carrier, right? And, a lot of times, or hopefully not a lot of times, but a lot of the times where somebody has failed the cognitive, um, is they're distracted, right? You have a high performing client and they're babysitting their grandkids or they're grocery shopping while they're doing the memory recall and then they mess it up. A lot of carriers, most carriers will not allow you to retake that, or they require you to go through a battery of neurological exams in order to be reconsidered. We will consider those situations, right? Of course, we're going to ask, you know, why was this cognitive, screen failed? Was it medical? Was it situational? And then, we'll probably order medical records, but I've had a good amount of cases flip from that. But in terms of like hotspots, I wish I could say, hey, we're especially competitive with diabetics, or we're especially competitive with, you know, breast cancer, but it's generally going to be consistent across the board industry wide from a hybrid LTC standpoint. I Our informal process is so solid and comprehensive that no matter what the medical condition is, just send it to them because that doesn't count as a decline if they say no, right? So, I don't even send out our impairment guide because it's so incomplete, right? It's just I just say, hey, go to our informal team.
Appreciate the honesty there. Um, Peggy asked, do you have to elect the premium deposit account option at application time?
No, no, we'll only facilitate a premium deposit account for enforced policies. So it's not even a part of the original application. It's an enforced process.
Cool. I think that's all we have for questions, unless anybody wants to get them in right now.
I just realized that this website is incorrect. It's securian.com/SecureCare. It's not password protected. You'll find all of our material on there. So you'll find SecureCare UL for California, SecureCare 3 for the states that are not yet approved for SecureCare 4, and you'll have SecureCare 4 brochure. So this will include product information. It'll include application guides, underwriting guides. It'll also include value add sales tools. So my two favorite are going to be how to plan for long-term care. It's a product agnostic planning sheet and the business material, right? Our pass-through entity and our C Corp worksheets for business deductions are extremely popular in the field because they're simple. I think they're like 1 to 3 pages long. You pair it with an illustration. So it's like a very easy DIY case study that you can personalize for the client that you're talking to. So you'll also find that on there.
Awesome. I wish I had, if I had a nickel for every time I did something like that with the link, I'd have at least 30 cents.
This is a brand new deck. I didn't put you guys through the entire deck, but I'll have a friendly conversation with our marketing rep. It's all good. It's just again securian.com/SecureCare. But if you need anything, just reach out to myself or Jason. I'm sure if you have any questions, just let me know and we can send those over to you.
Sure. Yeah, that sounds great. And thank you for this, Tim. This was super information dense, not just delivering some of the new details with SecureCare 4, but just a nice refresher on Securian and the SecureCare suite as a whole. So really
Yeah.
appreciate you taking the time to be here with us. And for everybody else, thanks for coming. Thanks for asking your questions. And I hope you enjoy playing around with what SecureCare 4 has to offer. And I think that's all I got for you today. So be well, and we'll talk to you this time next week. Have a good one,
Awesome.
everybody.
Thanks, everyone. Take
Thanks so
care.
much. Bye, Tim.
Bye.